The early stages of inflation are very good for equities, right? Because equities are going to have pricing power, especially cyclicals. Think about energy, materials, industrials, technology. They've got the ability to grow faster than inflation. And I think the big risk is that investors aren't recognizing the inflation that's taking hold in the United States. It's not strong yet, but it's very widespread. We're seeing it everywhere. All the talk of tariffs. Well, tariffs equate to higher prices. Tight labor markets, where we've seen, we haven't seen labor markets this tight since like the 1960s. When you think about things like initial jobless claims and that sort of stuff, these are readings that we haven't seen since like 1969 when, Jimi Hendrix and Janis Joplin were headlining Woodstock and the Jackson 5 was debuting on the Ed Sullivan Show. Labor markets are incredibly tight. That's going to push wages higher. All these things equate to inflationary pressures that are building. And what investors are doing is the exact wrong thing. They're doing the exact opposite of what they should be doing. They're pulling money out of equities and going into fixed income. And when the 10-year Treasury yield hit 1.35% in June of 2016, from that day to now, investors have put over $500 billion into fixed income and pulled about $130 billion out of U.S. equity mutual funds and ETFs. So in other words, as rates are going higher and inflation is taking hold, the asset class investors should be moving toward their equities because they've got the pricing power, but instead they're going deeper and deeper into fixed income, which I think sets them up for pain.
Most people think bonds and stocks are linked, though, and when you say it's going to be anything that worked for 34 years is going to stop working, I initially thought you meant stocks too, because you would think that financial assets are sort of correlated. No?
Well, we had the biggest bond bull market in history, right? 1982, the 10-year Treasury sitting at 15.5%.
Which coincided with a huge equity bull market, too.
Mm-hmm, absolutely, because we conquered inflation, right? Inflation gave way to lower prices, deflationary pressure. And what happened over that time is investors could go into fixed income and, experience these massive rates of return that I don't think they're going to experience anymore, yet they're still allocating their portfolios today looking in that rearview mirror.
It's going to get really confusing. Have you noticed?
About what?
What? The hear no evil, see no evil situation?
Joe.
Oh my gosh.
So it's going to get really. It's going to be really.
I thought the hear no evil, see no evil, which is a little bit of.
That is what I did. Yeah. Thanks for noticing that when I cover my ears, my eyes, and my mouth, you picked up on that. That's good.
Hey, Joe's on radio.
Yeah. Okay. Hopefully, there's someone.
I'm still trying to get over the Jackson 5 Jimi Hendrix image on the same stage.
Nice sprinkling.
And my favorite.
I worked on that one.
My favorite performer at Woodstock, Joni Mitchell, who one guy says he saw her there, although she wasn't there. Anyway, one of our guy who hasn't been on in about 10 years. Anyway, Joe.
Yes, sir.
Bottoms up.
Yes, we are bottoms up. So our job is a little bit easier than Joe's, which is...
Tell us what's going to work in that environment.
Well, we're looking at individual companies, so all the things that you've been talking about this morning, currency risk, interglobal machinations, are irrelevant to us. We're just looking at companies, trying to look at their cash flow. They can be anywhere in the world, so we do have that macro view, but it should come as no surprise to people that currencies are in trouble. Brazil went first. And very few people on your show are talking about dollar strength, and that's what's given birth to a lot of these problems across the globe. So Joe and I differ in the sense that I'm looking at a micro analysis, and it's much easier, and we're looking for companies that have high costs right now, margin compression that will return after they pass those costs along to the consumer. And we think that this is a great environment for investing.
You don't like financials. So
we stay away from financials simply because they're opaque, because we really can't look at them in the same depth that we can look at an industrial or even a technology name.
So industrials and information technology can eventually pass along the input costs that are rising because of tariffs and inflation, and then their margins can be maintained.
They're growing at this point in time. So it's easy to come on your show and talk about peak market, peak earnings, It's no surprise that people are talking about that. The surprise is that these companies will emerge and that this is a great opportunity to put your money to work in the market.
And Trennert's here. That's a palindrome, right? I mean, that's the coolest thing about, now that we did,
like Soros.
Didn't really finish Soros. Like Madam, I'm Adam.
Radar.
Madam, I'm Adam. Yeah, exactly. And that's the coolest thing about you. Well, I mean, you're great at
Thank you.
stocks and everything, but I just think and you used to be at ISI.
I know.
So that was all one
I had the whole thing going.
You messed that up with some people.
I mean, we certainly did.
So there's three Joes here. So you're going to, there's
Listen,
Josie. Oh my God, Josie! There's two Josies.
Two Josies.
Josie and Josie. That's weird.
We were talking
This could be a band yourself, the
that's
Josies.
weird.
Listen, I'm very much in agreement with both Joes, but I mean, I'm very much in agreement with the idea that the policy mix right now from the Trump administration is very much set up for inflation. Fiscal policy is obviously very expansionary. Monetary policy, particularly as it relates to bank regulations, is very certainly you want to increase the velocity of money as a result of that. Trade policies are somewhat inflationary, right? So you have everything is kind of geared towards higher nominal GDP growth. What's interesting about higher nominal versus real is that it's very highly correlated with business confidence and consumer confidence. So I'm very sympathetic to this idea that for a while inflation feels good. It tends to be politically popular, and it also tends to be good for certain types of financial assets. I personally like financials. That's our biggest overweight. We also like industrials. We like energy. And CapEx-oriented technology would be a big part of our overweights.